Okay, well, let's put the spotlight on the big deal that was announced over the weekend. Coforge has pulled off its boldest move yet. As CNBC TV18 reported, it has agreed to acquire Encora, creating a combined entity which is valued at $2.35 billion in revenue and ambitions to play in the big league of AI, product engineering, and cloud-led services. The deal is unquestionably big and strategic. But the question is Coforge paying too much? Let's go across to Rima for all the details on this mega transaction. Rima.
Thanks so much for that. I think that is the big question everyone is asking. Is this deal between Coforge and Encora expensive? Well, the short answer is it's a good asset, a great asset, but perhaps a tad bit expensive. Now, Coforge is paying $2.35 billion for Encora. This is a company with estimated revenues of $600 million, which means the acquisition is being done at an EV to sales of 3.9 times. Now, putting that in context, most global digital engineering companies today are trading in lower multiples. Now, this I picked up from a Motilal Oswal report where they're saying a company like EPAM is trading at 2 times sale. Globant is trading closer to 1.3 times. And even some of the recent M&A deals were cheaper. Now, Cognizant acquired Belcan last year at roughly 1.6 times EV to sale. Infosys bought Intech at about 2.6 times sales, which raises the valid question, has Coforge paid a premium? Especially when you see it in context, analysts point out, to Encora's organic growth, which is low to 7 to 8%, while Coforge itself has been growing much faster at mid-teens. Now, JM Financial summarizes by saying the valuation looks rich given Encora's 7 to 10% growth profile. Now, moving on, when the price is high, there is also very little room for error. So what are the risks? Well, I can see 3 of them. One is integration risk, because this is a very large acquisition, the largest done by an Indian company. Encora is more than 30% of Coforge's size compared to the earlier deals like SLK Signity, which were smaller. So when there is such a large asset, integration is not the easiest. Secondly, the management is also guided for the acquisition being EPS accretive by FY27, but this requires flawless execution. The second risk is dilution risk. It's an all-stock deal leading to 21.25% equity dilution for the existing shareholders. And on top of that, Coforge has the option to raise an additional $550 million via QIP to retire the debt. As of now, it's not decided by the management whether they will flex that option, but it's still an overhang. And the third one is the overhang from private equity investors. Encora shareholders will hold about a 21 to 22% stake in Coforge, and 50% of this will unlock after 6 months, the remaining after 12 months. Analysts say that this is a potential supply which will cap the near term. But it's not all negative. There are some real positives here. Now, post-deal, Coforge becomes a $2.5 billion revenue company with EBIT margins of close to about 14%. The management is calling this a defining moment in Coforge's journey. And there is a clear step change in the company's capability. Encora brings AI-led product engineering, and the combined company will have nearly $2 billion of AI-linked revenue. The deal also opens up high-growth white spaces for the company like high-tech and healthcare, and the revenue synergy potential is significant, especially through cross-selling, and Coforge does have a very strong execution and an M&A track record, which gives the street some comfort. From a stock perspective, just over the last couple of days, the stock had declined close to about 10%. So some of the concerns are being addressed. But other than that, it's been such a wealth creator. Its 3-year revenue run rate is, the stock price return is 120%. In the last 5 years, it's more than 1,000%. So it's a bold, transformational acquisition by Coforge, and now it's up to them to deliver on that.
Okay, indeed, a bold, transformational deal as well. Can they walk the talk? And can they really, create that scale and value? That is the big question. Let's actually discuss this with our next set of guests. We have Sandeep Agarwal, fund manager at Solio Investment Managers, joining in. In a bit, we'll have Bhavin Shah of Aquarius also with us. Sandeep, let me get your first take. We were speaking with Moshe Katria earlier on the show, and one really wonders whether this is going to be an acquisition really worth paying for. Your thoughts?
Hi, good morning, and thanks for having me on the show. So, I believe that you have to do strategic things, and from that perspective, Coforge has probably gone and done this, but there is very limited story of successes in such kind of acquisition. Particularly, as Rima mentioned, the integration risk, the execution risk are too high. One good thing in the deal is obviously it is an all-stock deal, so everyone's outcomes are completely connected. So I think from that perspective, it is very good. A really worrisome scenario would have been to if they were paying cash by raising money through equity or debt. But yes, having said all that, and I believe that there is a merit in the argument that EPM and Globant, all of them, and the transactions which have happened at a much lower price. So at this price, when you are acquiring something, the onus on meticulous execution is very high, and also the margin of error is very low. So I think time will only tell how it can happen. But I can tell you that Coforge management, when I was a sell side analyst, I've interacted with a lot of time. They are very good. They are second to none. So I also have a lot of confidence in their execution capability.
Okay, so you seem to be sounding optimistic on the way the company has delivered in the past. We also have Bhaven joining into the conversation now. Bhaven, thanks for being with us. By the way, season's greetings to both of you. Thank you so much for taking out the time and being with us ahead of the new year. Lots of news flow. So Bhaven, what's your sense? We were speaking with analysts earlier who said that Encora is not really an AI native company, ground up AI company, but those companies maybe are just too expensive for an Indian company to acquire. So in that context, does Encora make sense for Coforge?
So I think, first of all, they're acquiring using stock, and using a very expensive stock. So, in some sense, it might just work. And the other thing is that, with a full tax on dividend and buyback both, I think companies are going to have less of an incentive to pay dividends or buyback, and, might use that cash for more acquisitions. So I think what we have seen in 2025, more of that might come in form of acquisitions.
So Sandeep, I think the question is, what does one, gentlemen, good morning. What does one do with this stock now? It may be a bit expensive, but the management has shown flawless execution in the past. Their track record is good. So would you bet on Coforge now with this acquisition under its belt? Both of you. Sandeep, go first, and then Bhavin.
See, we have a very clear view since last 12 to 18 months. We are very negative on the sector. So we don't hold any position nor intend to hold anything immediately, because we believe another 12 months of pain is definitely there. I am very clear that if we buy something, we'll buy in R&D space, but at a right price, the current prices, and we don't go by PE ratio, because that is very misleading, because the growth rates have fallen a lot. We go by PEG ratio, and on PEG ratio basis, the whole sector is super expensive, and we don't have the guts, don't have the policy, don't have the mindset to buy at this prices at all. Anything.
Bhavin, same question to you. Coforge has been a wealth creator, but from here on, given the integration-related challenges, do you think re-rating from here, generating exponential wealth, is going to be difficult?
I mean, it's the second large acquisition in a very relatively short time, and I think I agree with the comments that it's a very expensive, stock. So and growth rates overall. I mean, obviously the companies like Coforge are growing at a faster pace than the large cap IT. But still, I think one has to be very careful with the valuations at this level. So, I mean, I think, one of the key metrics that we track is of cash flow yield. And we can look at operating cash flow yield if there is a big acquisition, but cash flow yield is also, operating cash flow yield is also very low.
So both of you, Coforge is in a void as of now? Sandeep and Bhavin?
I won't comment on a stock specific thing, but I will say that I don't like anything in the sector.
Okay. Bhavin, Coforge is in a void for now?
Yeah, I mean, we don't own it and we don't intend to buy it.
Got that.
Gentlemen, again, just to go back to the larger point on the way Indian IT services companies are trying to pivot towards AI and really, involve AI in most of their product offerings. So the large cap giants, which have these huge cash piles, they don't seem to be going the acquisition route at all. They are embedding AI in most of their, service offerings. TCS gave us a glimpse of what that might mean when they gave us a bit of a revenue indication. So do you think that pivot is progressing well or along expected lines, or is it too slow or too little? Sandeep?
No, so I think this is the only option which is there with the Indian IT services firm. And remember that, whatever people may speak right now, there is massive demand for the hardware. And I think hardware peak demand is behind. So these chips and all these companies have done phenomenally well. I don't know how long they will do well because hardware replacement cycle, in my opinion, is broadly over. Now the software companies will do phenomenally well. And then comes the turn of software services. The only challenge for us is that there is a 30% cut in the effort, which has not happened in the past in any disruption. So when there is such a sharp cut in the effort itself, despite you being the market leader and having 95% share in global sourcing and whatnot, but still when your effort itself is going to get cut, I don't know how much you can grow and for how long. So that's the reason I believe that our large cap IT companies are for a long period of time will be in 5-7% growth range on an average CAGR basis, and mid caps maybe 10-12%, the ones which are in ER&D, and the small cap may do better. So we are looking the sector from that perspective. I don't see high growth coming in for the sector for the large companies or the mid cap companies in next 2-3 years at least.
Bhavin, analyze the capabilities of Coforge now with this acquisition versus, say, the other IT companies now. Now, historically, it's always been Coforge and Persistent. These two were liked by investors. Now, how would Coforge's capabilities change post the acquisition, and how would it compare with, say, a Persistent?
Yeah, I mean, I think it's frankly, I haven't gone into that details for Coforge, this acquisition and capabilities. So, perhaps, maybe I'll skip that question.
Do you like, I mean, Sandeep's view is he doesn't like IT services company. If he has to buy, he'll buy maybe an ER&D company. But do you own anything in IT services in India right now?
Yes, I mean, I think we have spoken before. We own Infosys. I think we bought it, when it was like below 1500. And then I think we have seen a bit of a rally. We also have Mastech in our portfolio in the small cap space. And then we have IT related companies like Reddington, for example, more into distribution. One of the recent listings, iValue Solutions. So we have a few names, having a relatively different type of business model, which has still got a bit of growth and valuation is reasonable.
Got that. How does this, do you feel the other IT companies, Sandeep, will now feel the pressure to go out there, acquire scale, show high growth numbers, because organically they're not generating growth? So do you think that we will see more acquisitions now by other IT companies? Large cap IT companies have already started, even a TCS. But will we see more from other companies to shore up growth numbers? Sandeep?
No, I don't think that will happen because, I have seen last 20-25 years, Indian IT company managements are very, very, practical, and they know the situation, and they know this kind of, whenever this disruption happens, there will be lower growth and they have to tide through it. So I don't think they will do any acquisition due to pressure from anyone. But yes, if required, they will definitely go ahead and do. So I will say like this, that, Indian IT services management is top notch for all the companies. And that is the reason that, we have gained so much market share over the last few years. And that is the reason the financials have not got spoiled. We have tied through all the challenges from visa to whatnot. So I think management will not come under any pressure. I am pretty confident that, they will do the right things. And we have to accept that, in an industry, you see Accenture numbers for last 25 years, what kind of numbers they are giving, including in organic, they are not able to grow at all. So we are doing far better than that. And this is a reality that, when you have so much penetration in a mature services, your growth expectation has to come down, because these are more stable than even, fixed deposit kind of return. You are making 4-5% dividend yield and all those things. So you have to also tone down your expectation of growth, and so are the multiples have to systematically come down. So I don't see any challenge. This is like any other industry which matures.
Okay. All right, gentlemen. The debate on Indian IT will continue. Thank you so much for joining in and giving us perspective on the discussion today. With that, it's time for us to wind down on this edition of Bazaar. Do stay tuned. Chartbusters coming up next.